Okay, everybody, welcome to today's session for first-time home buyers. I'm Cheree, the money lady. So today's conversation is going to be from a lending point of view. What are the things that you need to have in place if you are going to purchase a home? So the goal of today is to let you know the things you need to have in place, a couple of the pitfalls that you want to be aware of, and to answer your questions without today's session being super overwhelming because there are some items within the home buying process that are generalized and others that are going to be specific to your situation. However, again, I'm here to give you like an overview of the things that you need. And for most people, this is going to be 90 to 95% of the overall things that you need to know in order to be successful in your home buying process. So I want to say hello to everybody on Facebook as well as everybody here in the chat. And if you have questions, you can always put them into the chat session or section of Zoom and I will see them. Alrighty then. So let's start with this just helps me kind of keep things straight here. I'm going to share my screen and I have to go back a couple of, there we go. All right, so good stuff to know. Getting a loan to buy your first home. This again is going to be our session this evening with regards to kind of the basics of purchasing a home from a lending point of view and getting that loan that you're looking for. So I'm going to start off with a little gamification. True or false? I have bad credit. I cannot get a loan. I have bad credit. I cannot get a loan. True or false? If you answered false, you are correct. We'll talk a little bit more about minimum credit scores, but there are loans available for people who have as low as a 580 credit score. So if you have the mid 600s, even lower 600s, there are opportunities for you definitely. So, and again, we're going to expand on that a little bit more as we go. True or false? I have to put 20% down. True or false? I have to put 20% down when I'm looking to purchase a property. If you answered false, you are correct. You do not have to put down 20%. Depending on the loan that you're getting, you could put down 0%, right? If you're a first-time home buyer, for some of the loans that are available out there, you could put down 3% or 3.5% as a first-time home buyer. In fact, the supermajority of you can put down anywhere from 0% to 3.5%. And that depends on the loan program that you're getting into. Now, there are some times when people come to me and they have a either specific property or a specific neighborhood in mind where they would want to put down more. But the minimums for the super majority of my first time home buyers, 0% to 3.5%. And I will talk a little bit more later on about when there are some caveats with regards to that. So, all right. Number three, true or false? I must have my down payment in cash in my bank account in order for me to get approved for a loan. True or false? Gotta have cash in the bank for my down payment and closing costs in order for me to get approved for a loan. If you answered false, you are correct. That's a false statement. We'll come back and talk a little bit more about this in a few minutes, but there are different ways that you can actually, different places where you can actually tap into money for your down payment and closing costs, including your retirement account. So we'll talk about that. True or false? I'm switching jobs. I have to wait in order to get a loan because I'm switching jobs. True or false? If you answered false, you are correct. Now, the way that things work is as long as you're in the same industry, you're going to have the same type of job. With just a job letter, a job offer letter, sorry, we're able to get you pre-approved. And then you would need your first pay stub before closing in order for you to get that house. That is if you have been in that job field for at least 2 years. Okay. So if you're going from being a nurse in hospital A to being a nurse in hospital B, or I had somebody going from being a nurse in a hospital to a nurse in a school, within a school system, perfectly fine, right? If you're looking like, hey, I'm getting a big increase in income and I want to be able to take advantage of that, in many circumstances, you can, right? Okay, this is the last true or false here. True or false? I just graduated from college. I cannot get a loan. True or false? I just graduated from college. I cannot get a loan. The answer is false. You can. What we as a lender will do is we will take your college transcripts and then your job offer letter, and you do want to have at least one pay stub, one set of payroll going into your bank account by closing, right? But I've worked with individuals who graduated from college a year ago, or 6 months ago, or just under 2 years ago, and you can absolutely get a home loan. So, all right. I will say this though. I had a couple of young men who came to me who wanted to buy a home, and they did not have 2 years of work experience. And they also were not in college and had not graduated from college. And unfortunately, we do require you to have 2 years of job work experience, whether that's a combination of college transcripts and job, or whether that is you're a young person, 20 years old, you'll say you're working in the trades or something like that, you're making good money. And once you have 2 years of experience there, then we would be able to get you a home loan at that point. Or you can have mom and or dad be a co-borrower with you for all of my young people. All right. So 95%, actually, I'm going to pretty much say 100%. 100% of people who are purchasing a home and you're getting a home loan and buying any kind of real estate is like a four-legged chair. It's a four-legged chair. If you're missing any of the legs, that's going to be a problem, right? It's not always, like you can't recover from it, but it's infinitely harder, right? So, leg number one is income. Leg number two is credit. Leg number three is debt. And leg number four is assets. And we're going to break all of these down. I do want to let everyone know, since I have more people coming in, if you have questions, feel free to put them in the chat. And then my session today is probably going to be about 35 minutes. And then after that, I will open it up for Q&A for any questions that you have. So we have this four-legged chair here for getting a loan. Let's kind of break each of these down. Let's first of all talk about income, right? What do we need to have for income? 2 years of job history at least, or your college transcripts plus your job offer for you to get the application in. And then we would want your first pay stub by the time closing happens. Okay. If you are a small business owner, we would need 2 years of your taxes or 12 months of your bank statements. 2 years of taxes or 12 months of bank statements. So, when I talked about down payments before, and I said that most people can get anywhere from 0% down to 3.5% down as a first-time home buyer, my small business owners, if you do not have a W-2 at all, is the only time where that may not be the case if you're going to get approved for a loan, right? At all. And the reason for that is my small business owner entrepreneurs, it depends on how your taxes are set up. If your taxes are not set up in the way that Fannie Mae or Freddie Mac or FHA will approve, then we'll have to get you either a bank statement loan or a stated income loan. And I will let you know for the stated income loan, the interest rates are higher, can be done. I'm working on one right now for a client, but the interest rates are going to be higher. So just expect that. I've done bank statement loans for self-employed people before. They take 12 months of your bank statements. They find out what industry you're in. They will look at all of the revenue that's coming into your bank statement. And they will basically say, okay, your income that we're going to recognize is X number of dollars. And that is an easy way, especially if you have regular income coming in, that's an easy way for you to get a loan. If you're a 1099, you've been a 1099 for 2 years, you can give us your last 2 years of 1099s and your last two pay stubs, and we would be able to get you approved that way as well. The big thing that the underwriters are looking for when it comes to income and job is stability, as stable income as possible. Even if you're in a small business with seasonal income, can they see like over the past 12 months that even though your income is seasonal, that you do have still some sort of base revenue coming in, right? So, and we can talk about that more over time. Okay, the second leg of buying real estate is credit. Credit is usually what people are concerned about. So the minimum credit score is a 580. I will tell you right now, if you have a 640 or higher credit score, then you will have more options with regards to loan programs. For all of my self-employed people who need to use their bank statements in order to get approved, 660 or higher is where you want to be. If you're using a stated income loan, I think you want to be at a 680 or higher for that specific loan program. And if you want to get the best terms and rate possible, 750 and higher is where you want to be with your income. Sorry, with your credit score. Okay. So those are the different levels. So I don't want you to think, oh my goodness, I have a 600 credit score. I cannot get approved for a loan. If you have a 600 credit score, but you have a job and some stable income, that could still be very possible for you. All right. So ways to boost your credit score, because sometimes people will ask about this. One of the easiest things you can do is ask for your credit card companies to increase your credit limits. Okay. And that has to do with the utilization of your credit cards. So if you can get those credit cards at a 30% utilization or less, then that is going to help your credit score. What's utilization? It basically just means if your credit limit is $1,000 and your balance due is $300, or the amount that you've used on your credit card is $300, that's a 30% utilization. So sometimes instead of people paying down their credit cards a whole lot, they will just call the credit card company and ask them to increase their limits. You can also pay down your credit card balances. We talked about that. Sometimes on your credit reports, there will be derogatory things because let's say you paid off collections and the collections company still has not corrected your credit report. Sometimes that drags down your credit score as well. Or sometimes there are old collections that need to be cleaned up. So there's a guy that I work with called Credit Ryan. He's really good at, especially of collections and things like that. Like he knows what companies will take 10 cents on the dollar. He'll help you create and formulate a program where he can help you increase your credit score. So let me know if you want to chat with Credit Ryan. Okay, so again, the four-legged chair, we had income, we had credit that we talked about. The third one is your debt. You absolutely have to have manageable debt. Okay, and the rough math with this is for every dollar that you have in debt, and your debt is what's on your credit report. So it is your student loans, even if they're deferred. It is that car payment that you have. It is your credit card payments, installment payments, anything you have with regards to debt on your credit report plus the debt that we're going to add with regard to the mortgage that you're going to get. So we add all of that together. And for every dollar of debt that you have, you need to have $2 of income. That's the rough math. For every dollar of debt, you need to have $2 of income. So if you were working with me, for example, and you're like, Cheree, I'm looking for a 6-month plan in order to be able to purchase a property that's X number of dollars, I would say, great. One of the things that I would do is I would do a soft pull of your credit and I would do this 2-to-1 math calculation for you and say, okay, based on where you're buying your property, what do we expect the mortgage to be? And the mortgage is your principal, interest, taxes, insurance, and any HOA or condo fees. I would look at that. I would look at all the things that's currently on your credit report. I would ask if there were certain things that we could get paid off before you purchase your home or you put an offer on the property. And we would basically do that math and we would come up with, okay, then either this is how much house you can afford, or this is the strategic plan you need to have in order to purchase the house that you want. So that's where the manageable debt comes in. And then the fourth thing you need are your assets. So again, your income, your credit, your debt, and your assets. And this is 100%. Anybody who is purchasing a home, you got to have these four things at least figured out, right? So, what are your assets? Your assets are basically the money that you would have in order to pay for your down payment and closing cost. It's the money that you would have to have pay for your down payment and closing costs. We're going to talk a little bit more about down payment and closing costs through this section here. So, we're going to talk about interest rate. We're going to talk about down payment. We're going to talk about monthly payment, and we're going to talk about closing costs right now. And then I will open up the session for Q&A. Okay. It's not going to take too long. So interest rate. Okay. Cheree, what's my rate? What's my rate going to be? What are the rates based on? I get that question all the time. I will tell you right now, when people tell you that the rates are 6.5% or 6.65%, understand that that rate is for a person with an 850 credit score, 20% down, really, really good credit, right? And a really, really good credit profile. If that's not you, that's perfectly fine. You're going to be paying in the sevens. right now. So it could be 7.25%, 7.375%, So your interest rate is based on different factors. It's based on your credit score, your debt, your income, your down payment, whether you are doing a 15-year loan or a 30-year loan. 15-year loans have slightly less interest than 30-year loans. Okay. And it's based on a few other factors as well, including what's happening with the Fed, and more importantly, the confidence that the bond markets have with regards to the future economics of the United States over the next 18 months. I can't tell you one thing about interest rates right now. Many of you may have heard that the Fed will most likely reduce interest rates next week when they have their meeting. That interest rate reduction from the Fed is already baked into today's interest rate for mortgages. So there is not a one-to-one correlation between what the Fed is doing next week and what's going to happen with mortgage rates next week. The mortgage rates actually are a bit of a forecast based on what they think the Fed is going to do and what's happening within the market. Okay. All right, let's talk about down payment a little bit. We're also going to talk a little bit about down payment assistance as well. So, your down payments can stretch from anywhere from 0% for our VA loan. So, if you are active duty military, if you are um, reserve, if you are retired military and you have not taken your benefits. And I heard, I think it was earlier last week, that quite a few veterans have not taken advantage of their VA loans with regards to home loans. If you're talking to me or any other lender, let us know that you're military and let's see if we can get you in for 0% down. Okay. Also, USDA loans are 0% down. USDA loans are for rural areas and some suburbs as well. So, one of the downsides of the USDA loans is, remember I told you, for your debt, for every dollar of debt, you have to have $2 of income. Well, USDA loans actually require you to have a little bit more than $2 of income. So there is like a trade-off there. But if you're buying in a rural area, let's talk about a USDA loan as an option for you. First-time home buyers, you can get anywhere from 3% to 5%. That depends on the loan program, right? But most people, if you come to me and you tell me you're a first-time home buyer and you really are watching your pennies with regards to the down payment, I usually put you into the 3% down option. Okay. Uh, Conventional loans for people who are not first-time home buyers are 5%. And then for people who are buying second homes, it's 10% down and 20% down for investment properties. So, these are the down payments that we're looking at for properties. And I do not have a slide here for down payment assistance. I will tell you that with down payment assistance, we have a nationwide program that will give you 3.5%, which is your down payment, your entire down payment for an FHA loan. We also have, if you live within Maryland, there are some first-time home buyer, they call it the Maryland mortgage programs that I have access to. I'm also licensed in Tennessee and North Carolina, where there are some local programs. And hopefully by the end of the year, if you're in Virginia, I will have access to the down payment assistance programs in Virginia. But whatever lender you're speaking with, ask them about the down payment assistance programs. I will be honest with you, some of the down payment assistance programs end up costing you more than it's worth. So if you're working with me, if you're working with anybody else, don't just ask about the down payment assistance itself. Ask them if you're going to have to pay any additional fees or any additional points to participate in that down payment assistance program. Because some of them, like I said, when I start digging into them, some of them charge you more fees than it's worth. So that's just one thing to keep in mind. We also, I think we talked about this before, but you are able to get your down payment and closing costs also from your retirement funds. And you can get up to $50,000, 50,000 from your retirement funds for down payment and closing costs. So there are quite a few people who will either borrow from their retirement funds or they'll just pull out their retirement funds tax free in order to be able to fund their down payment and closing costs. So. Next thing is monthly payments. Monthly payments we're going to talk about here. So, when we as lenders are looking at your monthly payments, we are looking at your principal and interest, your taxes, and your insurance. So, some of you may have been on TikTok. I mostly see these conversations on TikTok more than any place else, where people are saying, my mortgage went up and I don't understand why my mortgage went up. And some people's mortgages go up $500 to $1,000 a month. And every time, absolutely every time, if you listen to their story, it's usually taxes. It's usually taxes from new builds. So a person will purchase a new build, and when they purchase a new build, the taxes are super low because the county was looking at the taxes based on the fact that that property was just land and nothing was on it. So the taxes were super low. So a lot of lenders have been getting their clients in trouble because they will say, oh, the taxes on this property are only $30 a month. And then a year or two after they have closed on their new build, all of a sudden the county catches up and says, oh, there's a property on this parcel of land now. The taxes for this property are now $200 a month, and you have to pay everything in arrears, and you have a year to do it. So, what I want to encourage you to do if you're coming to me, if you're going to anybody else, especially if you're buying a new build, make sure that they are calculating your real estate taxes based on the current value of the property and not the value before the property was actually built. And if you're listening on TikTok and you're listening to people, like that's what you're listening for. Because I'm telling you, practically 100% of the time, let's say 90% of the time, the issue are taxes. 10% of the time, the issue is insurance because the person lives in California or Florida, and insurance in those places have gone astronomically higher. So it's usually not the principal and interest because you should be getting, I'm saying this, you should be getting fixed loans. You very rarely want to get an adjustable rate mortgage. So if you have a fixed loan, your principal and interest should stay the same. Also understand this, that every year, even if you're not buying a new build, your mortgage is going to go up slightly because your taxes and insurance is going to go up slightly. So my personal house over the past 6 years since we've lived here, um, my monthly mortgage payment has gone up about $150 a month, and that's due to taxes and insurance. But our house is appreciated as well. So, you have to pay more taxes when that happens. And closing costs. This is the final thing, and then I will open it up for questions. So, I give an acronym for closing costs when you ask, well, how much am I going to have to pay in closing costs? And my acronym is DELTA: down payment, escrow, lender fees, title fees, and appraisal, and anything else, right? So I'm going to go through these really quickly. Down payment, we've already discussed. Escrow is your taxes and insurance. And what happens at the closing table is the lender is going to ask you to bring a certain amount of money up front for you to have in, I will call it your escrow savings account. And what happens with escrow is every 6 months, the county will send your lender an invoice for your taxes, and the lender is going to basically write a check or send the money to pay your property taxes. Well, at the closing table, you are going to bring money to the closing table for them to fund the beginnings of that escrow savings account. Okay. So that's what escrow is. And again, it's for your taxes and insurance. All right. Um, Another thing you'll have are lender fees. If you're doing comparisons of multiple lenders, honestly, the only thing you want to compare are lender fees because the lender does not have control over any other fees or costs in the lending process outside of lender fees. So, what are they going to charge you to any kind of application fees, credit reporting fees, points based on the loan that you're getting, things like that. The next thing are title fees and then appraisal. So, appraisal and your home inspection are two things that you have to pay for before the loan closes, let's say it like that, during the underwriting process. So when you're ready to go and buy your home, you do want to have some cash or a credit card available for you to pay for your appraisal and for you to pay for your home inspection at the least, at the very least. Oh, and your earnest money deposit as well. But these are all the things within your closing costs. And the next step is if you wish to speak with me with regards to your home, want to know your next steps, you're able to come and talk to me about that. And then also, if you're going to buy in the next 90 days, you want a pre-approval, or you want to do like a real strategy deep dive, then I can send you our application link as well. So that way we are able to get that process started. So, I'm going to keep my phone number up here so you can call or text. What questions do you have? You can either take yourself off mute or you can put them in the chat so I can see both.
Hi, can you hear me?
Yes. Hey, Dana. Good to see you.
Yeah, good to see you too. I know I was late. I put it in my schedule, but I thought I had set the alarm to notify me. So sorry for my lateness.
Oh, that's okay.
Um, Very informative. So does this everything that you said first time home buyer, is this if you want to buy your own personal home or can you still apply this for an investment property?
So this is mostly for buying your own personal home. The difference with the investment property is you're going to put down 20 to 25%. Um,
Mm-hmm.
And then if you're buying an investment property, for most people, I suggest the DSCR loan that doesn't look at your pay stubs. All they look at is the property. And as long as the rental income pays for the mortgage, and you need to have about a 660 credit score or higher, and then you need to have about 20% down to 25% down, then you're practically approved. If you want
Mm-hmm.
a lower down payment for an investment property, I suggest people buy it as a primary, like actually live in the house as a primary, but you could buy a
Okay.
2 unit or a 3 unit or a 4 unit with 3% down as a first time home buyer, rent out the other units. That's how people do
Okay.
that. Mm-hmm.
Okay. Cool.
Yep,
Thank you.
you're welcome. And
I'll
this
reach
is
out to you
being
in the back
recorded,
end.
so I'll send out the replay as well. So,
Okay.
mhm. Other questions?
Hello, can you hear me?
Yes, ma'am. How you doing, Tamika?
Hi, how are you? Thank
Good.
you for this. So, I have a question concerning I've worked to get my credit up, income, and so I guess working to try to save. And I hear it's all these different programs.
Mm-hmm.
Um, so, with if you were to get 3% down or zero um, down for a deposit, you
Hmm.
still have to pay the other things.
Yes.
So roughly, I mean, how much are you looking at for closing costs if you don't have to do the down payment or you get like a just maybe you only have to put down 5,000 for the down payment itself. What about the other stuff,
Yeah. So
including earnest money?
yes. Okay. Well, I'm going to take out the earnest money and just talk about closing costs overall. They're going to
Okay.
be anywhere from 2 to 5% of the purchase price. And a lot of that will depend on where you're buying, what
Yeah.
county you're buying and where you live. One way, so I recently had a client who only had to bring $200 to the closing table.
Mm,
Now, he was active military, so he got a VA loan, so he didn't have to bring down payment. And then with the closing cost, he and his wife bought a house that was a little bit rural, right? There weren't any other offers on the property. And he had a really good agent, really good real estate agent that negotiated a 4% seller credit that
mhm.
could go to anything. So it's 4% basically of the purchase price. And we were able to set it up where all of that money went to closing costs, and he only had to bring $200 to closing. True story. But
Okay.
I'll tell you two things because realtors sometimes get upset when I talk about seller credits. But you have to work with a really good agent who knows how to negotiate them. And you have to buy a property that has no other offers on it
Yeah.
because like if and it needs to have been on the market for I would say at least 3 weeks. So it'll depend on how long like where you're buying, how long the properties are actually on the market. But in the Metro DC area, anything that's been on the market more than 3 weeks, especially if you're the only person putting an offer on that property, you could potentially negotiate seller credits and get more of your closing costs paid for that way.
So kind of unicorn property, so to
Yeah,
speak.
I would say unicorn property is just it's just a property that people aren't like salivating over.
Yeah.
So, if it's in the Metro DC area, it probably won't be near a metro, and it won't be in some of the top places.
Yeah.
But it doesn't mean it has to be all the way out in the boonies either.
Yeah.
Hmm.
And if you say that wasn't the case, and I'm not looking at properties over 200K, um, so maybe 5,000 would be a good rough start
It
if you
depends
don't
on
have.
Yeah, it depends on where you're buying, Tamika, to be
It would
honest with you. So
it
it could
would
be
be in the
5,000, could be
south,
10,000
like in Georgia,
in
and
Georgia.
I'm not
So,
talking Atlanta.
okay. So I'll admit I don't know the Georgia property taxes amounts, right? So it could be
Okay.
anywhere from 5,000 to 10,000 might be a good place for you to start. I would speak with a local lender and ask them. Um, ask them to give you a quick calculation. They should be able to do that. But I would imagine anywhere from 5 to 10,000.
Okay.
Yeah.
Can I just chime in that part?
Mhm.
If you also think about condos, because I was just looking at a condo in DC for 250. Now it was it was a pretty it was a condo, it was a one bedroom condo, but at that price point, I mean you could possibly find like condos that are not moving off the market. So you don't necessarily have to leave the area to find something at that price point.
Yeah. So I will tell you two pitfalls with condos, just
Yeah,
for you to think about. The first one is the condo fees.
yeah,
True story. I have a client who is in the Metro DC area. She's in Maryland. And she said, "Oh, Cheree, I want properties that are 250 or under." And when I started looking around, the properties had an 800, true story, $800 a month condo fee. I was like, "Oh my goodness, you would never qualify for this because, and like I told you, I'm sorry, I didn't tell you, we have to add the condo fee in when we're looking at your mortgage and the debt, right?"
yeah.
So, number one is the condo fees. And I have another client, it's the same, close to the same. The second thing with condos, which is really big, is that not all condos can receive a loan. There are some condos, it's called unwarrantable. That's the fancy name for it. But it basically means that you cannot get a traditional loan on that condo. So, if you're trying to get a 3 to 5% down payment, even with down payment assistance, and that condo does not accept that financing, and I can talk to you about it more if we need to. But basically, Fannie Mae, Freddie Mac, FHA, they have a list of condos that they will loan on, and all other condos, either they won't loan on, or you have to when you like put an offer on the property, you would have to actually apply to get that condo accepted. So there's a couple of pitfalls.
Yeah, and then also just I don't know about. Well, I used to live in a condo actually up in Maryland, but I was renting. So yeah, I do know about those high HOA fees up there.
Mhm. Yeah.
Um, but I would love to live in a condo, buy one, but I want to house hack first.
Hmm.
And a lot of times, the condos have restrictions on how many people can actually rent out. So that's in goal. And then with the changes, especially like the condos in Florida, where because of the that collapse that happened some years ago, it's just
Hmm.
a lot of different added fees and things like that, and just the way they're doing things is just it's needed, but it's just rough right now.
Yeah. Yeah, so just have to be careful of condos. So I always suggest when people are like any property that somebody who's working with me is putting an offer on, I ask them to let me know before they put an offer on it and preferably before they go see it, just to make sure that it's going to work for them in their situation. But with condos, you do have to be careful.
And real quick, do you have any suggestions or questions to ask when you're trying to find a lender to know if you're getting a good lender? Any
Very good
tips?
question. So I don't have like a list already prepared, but I will say that number one is you have to get a feel for them and their communication style. And do you clearly understand what they're trying to tell you? Because lending is, there's a lot of rules, a lot of guidelines, and if that person can't clearly articulate and communicate with you, like, this is what this means, this is what this means, we have to do this, and this is the reason why, then it's probably not going to be a good fit for most people. Also, if you're a first-time home buyer, you do want to work with somebody who either has worked with first-time home buyers or has a lot of patience for the questions that you're going to have, right? So that's two big things. The third is just getting a feel for their loans, right? Do they have the loan or loans that you need in order to be successful? And most of us do have loans. I'm sorry, do have like the general conventional and FHA loans. It is illegal for somebody who does not have a license to be a lender unless they work in a bank or a financial institution. So, if you go into a bank or a credit union, you don't have to ask about licensing, but if not, then you probably want to ask if they're licensed. And um, I would say the final thing is the lender fees as well. So just getting a feel for that. You don't necessarily want to go with the absolute cheapest person if they are not going to be able to get you to the closing table. However, I would be thoughtful with regards to the lender fees as well.
Okay.
Hmm.
Thank you.
Other questions? I didn't see any on Facebook. So, yeah. Other questions this evening? Okay, ladies. Well, I will give you the rest of your evening back. I will send out the replay as well. And I hope you all have a wonderful evening. Call or text me if you have any additional questions with regards to the lending process. And then, uh, Tamika, for Georgia, if you need a referral to a lender, let me know, and I can connect you with someone in our company that has a Georgia license, and you can interview them, see if it's somebody that you would want to work with.
All right. Thank you so much.
All
Appreciate you.
right. Take care.
Thank you. Bye bye.